Good morning. It's really a great one, let's be honest. It's a little cold, but still a great morning. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Monday, the 14th of November. Yes, I know. Those of you sitting there doing the math saying, hold on, one, two, is next week? Could it be possibly actually Thanksgiving? Yes, it is next week. I'm your host, JD Durkin. Opening bell rung just moments ago by PIMCO, this to celebrate its active bond fund. Congratulations to them. Stocks opening here after a solid week on Wall Street, which saw all of the three major averages in the green. A solid week, yeah, to say the least. This on the back of a bit cooler than expected inflation data as traders bet that the Federal Reserve would ease its aggressive rate hikes. Well, they actually, I don't know, but it's the hope. There's the sentiment, the wishful thinking, perhaps. Let's take a look at what's on tap for this Monday morning's broadcast. We put last week's rally into a bit of big picture perspective as the S&P comes off its best week since June. Plus, we take a close look at the big names for retail stocks ahead of the Thanksgiving holiday. It's a big retail week, folks. You're going to hear that word a lot. And finally, we'll bring you the latest in the FTX fiasco as the company continues to deal with the fallout. In fact, I'm sure there's been more developments in the FTX fiasco since the time we started the broadcast 60 seconds ago till right now. We'll get into all that and more in just a bit. For more on those stories and so much more, we now bring in our senior editor and markets correspondent, the man with all the answers, Mr. Martin Baccardax. Martin, good morning. Hope you had a fantastic weekend. The S&P had its best week in nearly 5 months on the heels of better than expected inflation data, at least more welcome than expected inflation data. Do you see this, however, as a bit of an overreaction, I wonder?
That's a tough question to answer, JD, to be perfectly honest. I mean, like you say, we had the best week for the S&P 500 since June, and also the best week for tech stocks since March of this year. So you could argue that the overreaction was probably, or that's the best term for it. But I actually think that in the main, this was probably the correct reaction to what really a lot of people are starting to come around and accept, and that's there is going to be arithmetic change in inflation readings going forward. There will be bumps along the road, of course, because the measurements are not always as pure as we would like them to be. But I was struck by a report over the weekend from Morgan Stanley, crunched the numbers. They say that by the end of next year, inflation is going to be below 2%, and that's the Fed's preferred target. And we could be talking about rate cuts in about 12 months' time. Now, we're nowhere near talking about rate cuts right now, but I am firmly in the camp of those who believe that that October reading was a predictor of where we are headed in the longer run with regards to inflation. The Fed, of course, again, trying to tame down expectations of a pivot on the rate hike path. They're saying that whilst it might be slower, we're still going to get to a similar endpoint that was predicted a couple of months ago. Markets aren't buying that, and the endpoint for Fed funds futures is drifting lower as a result. And we're looking at smaller rate hikes in December and indeed beyond. So whilst the market reaction itself might have been maybe a bit more robust than we would have accepted, I do think that the general direction is valid, particularly when you focus it against that CPI reading.
Martin, I just wanted to clarify, was that you said it was Morgan Stanley that gave that sort of expected forward-looking kind of projection,
Yes,
if you will, on that 12-month window?
Yes, that's right. They say that they'll see headline inflation drifting below 2% by the end of next year, and then we will get into discussions about rate cuts as a result, because, of course, that's predicated on the fact that the economy will weaken and potentially dip into recession next year as well. So if we are looking at declining inflation and a recessionary economy, rate cut discussions will follow very quickly after.
Yeah, I wonder if there's a little bit of a disconnect because we heard Fed Chair Jay Powell recently in the last couple of weeks say not only is the end terminal rate going to be higher than we once thought it was, Martin, but he also indicated, hey, we're probably going to leave rates locked there for a longer period of time than a lot of people previously thought. So I wonder if there's a little bit of an early reaction. Are people very, to some degree, are some investors quick to forget what Jay Powell, the man, said versus what the inflation data may have led them to hope to believe in the last couple of days?
Well, imagine, JD, if you took one of your best friends to a restaurant and he told you he was desperately hungry and he was going to eat everything that you put in front of him. And then 10 minutes later, after picking at his plate, he pushed it to the side and said, well, I'm full. I don't want any more. And you were stuck with the bill. You would be hesitant to believe him the next time that you guys went out to eat and it was your turn to pay. And I think to some degree, that's what the market is looking at with respect to Chairman Powell. This time last year, he was talking about inflation being transitory. This time, of course, he's saying it's a lot worse than we thought, and rates are going to have to be higher as a result. The truth probably lies somewhere in the middle, and I think that's where investors are looking to, and they're doing their own number crunching rather than simply believing what the Fed chair has to say. That's not to suggest in any way that he is being dishonest or misleading. I just simply believe that he wants to be as conservative as possible so as not to entice or sort of trigger a market reaction that will then lead to disappointment if the data were to turn the other way.
I guess it does determine and really decide on which restaurant we're talking about that I'm at with my friend at. Is it a Capital Grill? Is it something very nice and expensive plate? Or are we at Chili's with like a margarita and like at the end of the day, it doesn't come out to be that much? But point very well taken regardless. No, I wouldn't. That's the go-to. I'm saying I prefer the Chili's route because it's a little easier on the wallet than a nice afternoon at Capital Grill. I love Capital Grill, no disrespect, but the Chili's or an Applebee's, it's just fine by me. What else is top of mind? Okay, let's make this segue here back onto the rails. What should be top of mind? What is top of mind, you think, for investors as we kick off this trading week, as they're still trying to digest what happened last week?
We're going to do this quiet transition, I think, JD, from inflation focus to consumer strength focus with an inflation subcomponent built in underneath. Obviously, we're getting earnings this week from Walmart, from Target, from Lowe's, from Home Depot, really companies that are at the precipice of consumer strength, and they are going to have their finger on the pulse of not only how spending has materialized over the September quarter, but indeed what their anticipation is into the holiday season. I think those are going to be critical readings for sure. Then, of course, we're going to get October retail sales data from the Commerce Department on Thursday. That will be interesting because we will see how consumers were able to weather an increase in gas prices and whether or not that pared back spending on more sort of non-discretionary items, or indeed discretionary for that matter. So those numbers, I think, are going to be critical in us understanding how consumers are holding up, whether the pandemic era savings have been run down to the degree that some economists expect, and how they see their spending patterns into the holiday quarter, given the fact that whilst inflation is slowing, it's still significantly elevated, and we are hearing more and more about job cuts, hiring freezes, and a modest weakening in the labor market. All of those are kind of coming together into a sort of pocket, if you will, of data and expectation. And for my money, they are going to be reliant on consumer strength more than anything else, because whilst we can predict arithmetically where inflation is going, it's far more difficult to do that with respect to retail sales and consumer strength, because of course, consumers and shoppers and the rest of us tend to be irrational under these conditions. So I'm very interested to see what the retailers have to say and what the data has to say, and what that will mean for the strength of the consumer going forward.
So let's actually talk retailers. I was going to ask you about the election, but do you want to do earnings? Actually, I'm going to let you decide. It's like a choose your own adventure, if you remember those books. You want to jump right to earnings, or you want to hit our election latest from the last weekend?
I think the election stuff is really interesting, JD, because I think the ability of the Democrats to capture the Senate was something that simply wasn't on the cards heading into last week's vote. Obviously, there's still a lot of ballots to be counted. I think it does a couple of things. It certainly neutralizes any concern that the Biden agenda is going to be completely blunted by Republican lawmakers who appear to have gained control of the House. But it also, of course, then indicates that we won't be as focused on the December runoff in Georgia as we might ordinarily be. In some respects, that's probably good news for financial markets, because they won't necessarily have to deal with the political distractions for another month and can actually start to sort of regroup and marshal their efforts with a better understanding of how Congress will operate in January and beyond.
How nervous should investors be who were betting on a split government, especially those investors who said, oh, they'll be calling the House election night at 7 o'clock, and then it's up to the Senate. And now suddenly it's a way different conversation 5-6 days later.
It certainly is. I wouldn't anticipate that this opens the door to any major legislation. I think the one piece of significant information over the weekend was that Nancy Pelosi has talked about having a lame duck vote on the debt ceiling, which I think is actually probably a sensible move in the sense that they could probably push that a new debt ceiling sort of condition either well into the future or perhaps even permanently. because this absurdity keeps rolling up every 6 to 8 months now as a result of congressional intransigence. Essentially, JD, if you were to imagine that you had an annual budget that you could not exceed, but you didn't have any break on the day-to-day spending that you made, that would be an absurdity. You wouldn't simply be able to operate under those conditions because your day-to-day spending would pile up to the degree that it would overtake your annual cap. And that's exactly what's happening in Congress right now. There's no break on how much they can spend, but there's an ultimate debt ceiling. So until the two are sort of molded together, this, just preposterous discussion will continue to increase. And of course, it continues to raise questions about the probity of the US government, its ability to meet its debt and treasury market instability and all that. So I'm to some degree hopeful that there will be a vote on this so we can put that aside, if not for the year, at least for a very long time going forward.
Yeah, of course. Secretary Janet Yellen has urged lawmakers here to say, essentially, as soon as we can tackle this debt ceiling, that is the time to do it. Even if that is the lame duck session, you don't want to put yourself into a position where Congress is broken or brokered with both parties having a say. Then they start wanting additional things attached to it that sort of dilutes the original purpose of the bill. Those conversations in Washington may pick up in the next couple of weeks here. I do want to also get your take here. If we can go back to the Fed for just a second, and I forget if you mentioned it in an early response, so forgive me if you did. The CME Group Fed Watch is a really interesting statistic, Martin, that you cover a lot. And from time to time, I like to ask you about the likelihood that they project of another rate hike for the Fed. What are we expecting for December? Is it still, even despite last week, pretty firmly going to be another 75 or 0.75?
No, it's changed pretty quickly, JD. We're looking at now about an 80% chance of a 50 basis point rate hike in December, and that's down significantly from, I think it was about the high 50s prior to the CPI reading last week. So we were inching towards that smaller rate hike, and I think the CPI data simply just cemented those bets. What's interesting now is that bets on a 25 basis point rate hike are starting to creep in for February and beyond. And that's changing the assumption for the terminal Fed funds rate as well. Notwithstanding the comments from Fed officials saying, let's not get ahead of ourselves, we still have a lot of data to get through between now and then. But you can see the trajectory of those bets changing in real time. And it was a big reason, JD, why we saw such a dramatic move in the US dollar in the latter part of last week. The dollar had its worst week in a little bit more than 2 years, one of its biggest single-day declines against a basket of its global peers in about 20 years. And last night, China reset the value of its yuan by the most in a single day since 2005. So the anticipation of where the dollar is going to be headed has changed dramatically through foreign exchange markets around the world, largely predicated on the fact that investors aren't anticipating these big rate hikes from the Fed going forward. So even with commentary suggesting not to get ahead of ourselves, everybody's gotten ahead of themselves.
Powell has previously said that the risk of doing too little outweighs the risk of doing too much. I wonder to what degree he is likely to be swayed by just 1 month or even 1 week of really positive data when he's been pretty clear to say, we need to stay the course, even if that's not necessarily what investors want to hear.
I don't think that he's going to be swayed. I think it is going to take a few months of determinative data that shows that that headline CPI at the very least, or the Fed's preferred measure of the PCE price index, are heading closer to that preferred 2% target. There has been all sorts of discussion about changing the target itself because it may not reflect sort of typical conditions in a global economy that's, of course, susceptible to changes from governments and from markets and from investors all around the world. But that's a little bit more pointy-headed than what we're looking at now. I think ultimately, from a simplistic point of view, it's going to take 2, 3, and perhaps even 4 months of data from the CPI and PCI readings to change the Fed's perspective. But again, if you are an economist crunching the numbers, you can see most of that in the future because, of course, all of these data are measured against a point in time last year, and we're simply not going to see acceleration from those points because they were the fastest in 40 plus years. So there's an absolute sort of arithmetic certainty of slowdown. Now it's just a degree of how quickly will it retreat.
Okay, let's pop back to the big week it is for earnings, especially in the retail space. We've got Walmart, we've got Target, we've got Home Depot. We can dig into some of these names with a bit more of a fine-tooth look here in just a moment, but I wonder, are those the top names you're following, and are there others in the retail space that I did not mention that you think are really important for investors to pay attention to in the next few days?
Yeah, Walmart and Target, I think, are certainly the most important, and they come first thing on Tuesday and Wednesday, respectively. So I will be focusing on those for sure. Walmart, in particular, given the fact that it had to bring forward some of its holiday sales plans as a result of wanting to capture consumer spending in the month of October, against the risk that consumer strength wouldn't be as robust heading into the holiday period. Walmart has also had to work through a lot of inventory issues, as had Target, over the summer and September months. So we'll see where they stand in terms of that inventory overhang and whether or not that's going to elicit price cuts in and around the December period, which is exactly when retailers do not want them, and what the anticipation is for Black Friday sales as well, and whether or not we're going to get the same sort of activity. There was a relatively dated report from Deloitte maybe about 4 or 5 weeks ago that anticipated overall holiday spending to rise about 7% from last year to around 1.4 trillion. I don't know if those numbers are still valid, but they're probably within the ballpark. But that will be one of the slowest growth rates we've seen outside the pandemic in a number of years. So we are absolutely seeing a moderation in discretionary spending from the American consumer. This week, we'll understand a little bit more as to what degree that moderation will be.
And what do these retail earnings typically tell investors about the state of the overall economy? Give us a bit of perspective, Martin, as to why they're so closely watched on Wall Street, especially as we work our way through such a crucial shopping month like November.
Well, ultimately, I think that's it. It's simply the fact that we are heading into the Black Friday period, which, of course, is a nickname for that shopping date after the Thanksgiving holiday, when American retailers basically generate the bulk of their profits. They go into the black, as it were, as a result of the sales from the Friday after Thanksgiving until the days after the New Year's holiday. So that is, of course, intentionally important for retailers, and they need to capture a lot of spending in that period because they've had such a miserable year so far. So what we really want to understand from retailers is a couple of things. What they see is as the trajectory of consumer spending, to what degree their inventories have been expanded, and therefore will they need to discount prices in order to get rid of it, and then ultimately what margins are going to look like, given the fact that companies did have to buy their materials and their inventory in and around supply chain disruptions. So did they overpay and then have to increase prices, or were they able to use their leverage and buying power to underpay and then can therefore pass on some of the savings, at least, to consumers? So there's a lot of detail to pick through. And again, furthermore, on top of all that, JD, it's just worth remembering that consumer strength drives essentially about 2/3 of growth in the U.S. economy. So this period of spending and retail activity cannot be underestimated in terms of its importance for the broader U.S. economy.
Since we will have Walmart before the bell tomorrow, and it's our last time talking about those numbers, just wanted to see if there was anything else that you wanted to mention there specifically on Walmart we did not get to, or anything otherwise that you're expecting from the retail behemoth.
I'm really looking to that inventory number, I think, JD, more than anything else. They did have some difficulty over the summer and into the autumn months with respect to the overhang. They were able to work through some of it, but not all of it. I think investors will be looking specifically at that to understand what they can expect in terms of profit margins going forward. I'll also be interested to see what degree online sales are contributing to the overall retail picture in Walmart, because they've made quite a push against Amazon with respect to expanding their online offering. So I think those two things will be, at least from my perspective, what I'm going to dig through when the numbers come tomorrow.
All right, and speaking of numbers, we will get October sales numbers on Wednesday of this week, if I'm not mistaken, from the Commerce Department. I feel like we want to see low spending, right? We want to prove that the spending power of Americans is starting to weaken, because that would be in line with the Fed's very publicly stated goals. Are we expecting an increase, however, from these figures Wednesday on Martin? And if so, what would that mean?
Yes, the numbers Wednesday or Thursday. I have a feeling it might be Thursday, but I could be wrong about that. But what we are expecting is a modest increase in the top line number of retail sales. And a big portion of that, JD, is going to be the result of an acceleration in gas prices over the month of October, which of course started to spike as a result of the jump in crude prices. So the overall nominal number is going to increase. And a big portion of that, or at least a notable portion of that, will be as a result of sales at gas stations. So there is also going to be a component of used car sales that will bulk up that number as well. Used car prices fell in the month of October, and that actually probably helped overall sales because the volumes would, as a result, become higher. But what we'll look at maybe more closely, JD, is the control number inside retail sales, which strips away autos, it strips away gas station sales, it strips away gasoline sales, and a couple of other components, and tries to get down to the essence of consumer spending on a month-on-month basis. We'll probably see that edge a little bit higher. Job market still reasonably robust. Consumers still have some pandemic savings that they can use to blunt the impact of inflation. But whether or not those numbers remain robust into November, which is typically a little bit weaker ahead of the December period, and then into 2023 is another question.
We're also due for some fresh housing data this week. What are you watching there, and what should our viewers know if this is the first time they might be hearing about it?
Yeah, Wednesday and Thursday, JD, will be the numbers that are most interesting in the housing space. The Mortgage Bankers Association will give us an indication on where we are on 30-year borrowing rates. It may come down a little bit now that we've seen this big deceleration in 10-year bond yields in the dollar and in anticipation of Fed rate hikes. How much is another question because it's still firmly over 7%, but any relief is going to be of significant importance to the housing market for sure. And then we'll get a sense of where we are on new construction, building permits, housing starts, and all the rest of it on Thursday morning, and to what degree that's rolling over compared to last year's figures. There's still some issues in supply chain, which is inhibiting construction. There's still a little bit of concern as to whether or not there's enough demand for the new houses that are likely to be built as a result of the spike in mortgage costs. So all of those will certainly need to be picked through. And the housing market, I think it's probably second in importance from the Fed's perspective to the jobs market with respect to the need for a slowdown. It's not good news, of course, for those who are trying to buy or indeed for those who are trying to sell. But any deceleration in activity in the housing market will be good news from the Fed's perspective because that will begin to blunt some of the inflation headwinds. So not only will we be watching, but the Fed will be as well.
Speaking of things to watch, how much time do we have left in the show to talk FTX? Because we could do it for a very long time. The company somehow went from $32 billion into bankruptcy. What did we learn this weekend, Martin?
Well, first and foremost, JD, we learned that the $32 billion valuation was absolute fiction. And it's a little bit irritating that that number was bandied about for so long because it had absolutely no relation to the reality that we saw from documents that were released prior to the FTX bankruptcy filing on Friday. The Thursday balance sheet indicated assets of no more than about $9 billion. And a great deal of those were these ephemeral assets that were linked to crypto tokens and digital tokens and all the rest of it in various markets around the world. The most significant was this, JD. The biggest asset on the balance sheet prior to the bankruptcy filing was a $2.2 billion holding in a token called Serum. Now, Serum was invented by FTX itself. The market cap of Serum on that Thursday was $65 billion. FTX was telling us it was worth $2.2 billion. So this is kind of indicative of what we are seeing in the falsehoods that this company was providing to investors, to depositors, and to people transacting on the platform. It was absolutely a tower of piffle in terms of its probity and exactitude. This company, to some degree, didn't exist in any way compared to what we thought it did. And as a result, the collapse was so quick and so spectacular. I was tickled, JD, by the fact that the most attractive asset on the balance sheet for a company that claimed to be at the forefront of cryptocurrency engineering was a $200 million US dollar cash deposit. That's probably what's going to be worth the most of all of it.
That's incredible. Now, Sam Bankman-Fried's own hedge fund, Alameda, that's a name that a lot of people will see in the headlines. We learned it's not only the largest customer of FTX's, but also that Alameda was able to use customer funds. And I wonder, as you watch this story unfold the last 4 to 5 days, do you get the sense this is a drip, drip, drip kind of story, Martin, that's likely to continue unfolding with unsavory detail after unsavory detail for the days and weeks to come?
Unquestionably. I mean, this was meant to be the paramount in the cryptocurrency world. This was the company run by a man whose parents were compliance lawyers, who had the ear of regulators all over the world, particularly here in the United States, and was cozied up to some of the biggest names in politics and entertainment as a result. To put it bluntly, JD, people believed him. So they believed what he was saying about the value of the assets, or in this case, not, that were on the balance sheet. If these turn out to be false, and every indication seems to be that they are, people are going to question the validity of assets held on exchanges all over the world and the assets that are underpinning digital tokens that trade on them. This, I think you're absolutely right, is going to come out on a drip by drip basis, because investors, if they are smart, are no longer going to believe the words of the men and women that run these companies. They are going to demand audited results. They are going to demand evidence that there is financial backing for the tokens that are being traded on a day-to-day basis. Now, whether or not this will prove enough evidence to underpin confidence in the market remains to be seen, because, as I mentioned, balance sheets basically put a value on serum tokens that bore no relation to reality in terms of their market capital. So there will have to be even deeper questions and deeper probing in terms of what we think are the value of these assets versus what they actually are. And the complexity surrounding them is making that even more difficult. So this has shaken confidence in the crypto industry to the absolute core. And I don't think anybody anticipates that this is going to draw a line underneath that.
With our remaining minutes in the broadcast on this Monday morning, let's now switch over and focus on our rapid fire section. There we go. Words are tough on Monday. Okay, first up for rapid fire, what do we know about Joe Biden's potential new Alzheimer's treatment? Maybe of interest to lots of people. What do we know?
Well, essentially what happened, JD, overnight, or at least early this morning.
Yep, Martin, we may have missed your audio there. We're going to reconnect Martin's audio because I do want to try and get his response at least to this question here. Martin, if you can hear me,
I can.
I'm going to bring you back in. I got you. Okay, now we can hear you. We just missed your last couple words there. We're talking about the president's potential new Alzheimer's treatment.
Not the president's, JD. It was a company out of Europe called Roche. It's a pharmaceuticals group that had published trial data on 2 developing Alzheimer's treatments. And essentially, those trials, which were spread over a couple of years with a number of thousands of patients, didn't meet the endpoint in terms of slowing the cognitive decline that's associated with Alzheimer's. So that was disappointing on face, but what it did was probably allow companies like Biogen and Eli Lilly to emerge as market leaders in Alzheimer's treatment, which is really only at the nascent level. We only have one FDA-approved treatment out there. There's a couple of others that are developing from Eli Lilly and from Biogen. And the market anticipation is that these will probably generate sales that could be up to $30 billion a year by 2030. There's many, many millions of people around the world who suffer from this dreadful disease. And of course, it has cognitive impairment that lasts for a number of years and just reduces quality of life to a degree that's really quite sad. So it was unfortunate news that Roche wasn't able to sort of include itself into this marketplace, although they said, and I think correctly, that the data provided from the study will prove to be terribly important. But the market reaction today is more about the fact that now it seems the de facto market leader is going to be Biogen, and if Eli Lilly's treatment is ultimately approved by the FDA, they'll join them.
I do apologize. Yes, my prompter does say Biogen. I misread it as Biden. My apologies there as I was working to get your audio scrambling back up. That's my fault. Let's move on to number 2. I have it here. Elon Musk is buying ad space on Twitter for himself. What other company is involved with this?
This is a fun one, isn't it? SpaceX, which is one of the companies, of course, that Musk is a majority owner in and is a CEO of, operates the Starlink satellite phone service. So he has bought a package of advertising for Starlink that will be put into the Twitter space. Now, he has basically downplayed this and saying he's doing the same for Google and for Instagram and Facebook and others, and he's probably right about that. But there's no question that he's going to have to pump some ad space into the Twitter platform because so many other big names withdrawing their spend or pausing their spend as a result of changes that he's putting forth since becoming CEO a couple of weeks ago. GM being one of the most significant. I think Volkswagen has pulled, General Mills has suspended as well. And that's, of course, significant that he's trying to increase revenues. He also mentioned over the weekend, JD, that he has a lot on his plate and that he's working 24/7 to manage the 4 companies that he's at the helm of. And as you can probably imagine, and not to anyone's terrible surprise, Tesla shares are trading lower this morning as a result.
All right, number 3, does Tyson Foods have reason to be bullish on beef?
Bullish on beef. They actually boosted that. This is a company, I think, JD, that's fascinating on a number of levels. The first being it's the biggest food company in the world, essentially, with the chicken and beef production that would just mystify most people's expectations of the industry. But they are incredibly important, and they provide a great deal of the food that ends up on grocery shelves, not only here in the United States, but indeed elsewhere. They have boosted their full-year revenue forecasts to about $57 billion as a result of better than expected third quarter earnings. They beat the street by 10 cents on the bottom line, and they also had stronger than expected revenues of about 7% up from last year. They've raised prices for their chicken, which is one of the biggest divisions of the company, by about 18%. This, of course, contributes to the fastest food price inflation we've seen in decades. But they were still able to grow revenues in that division as a result. So people are prepared to absorb the prices to put food on the table. And we've seen that before in downturning economies where food actually performs better than other non-discretionary items, because that's the first thing that people will spend upon. And then, of course, they'll put the spending tentacles out into other portions of the economy after that. So Tyson does seem confident that its customers are going to weather these price increases, and therefore they're lifting their expectation not only for overall sales, but for overall beef sales as well.
All right, 4th and final. What's up with the Buffalo Bills?
Oh, my goodness.
That was an incredible game. I could not believe the highlights of that Minnesota football game. I've never seen anything like it.
It was so much fun, wasn't it? I was actually confessed, I watched most of the Dolphin game. Once that was under lock, I switched over to the Bills because I wanted to see what was happening there. And I was lucky enough to see the last 6 or 7 minutes, which were just an extraordinary back and forth of incredible athleticism and poor decision making. It's just amazing how the two of those can come together. But JD, what amazes me more than anything else in this game and the modern American football is how 1 minute doesn't really mean much of anything anymore. It's amazing that you can play 55 minutes and not much happens. Suddenly there's 45 seconds left and the teams can march up and down the field at will. I'm not entirely sure why that happens, but it makes it certainly fun to watch.
I gotta say, I might be inspired to change my Twitter bio to the phrase incredible athleticism, poor decision making. I'm just such a fan of the 1-2 punch that you presented here, so much so I had to write it down. Don't be surprised if I tweet that or just make it my own. I don't know about the incredible athleticism part, but the poor decision making, maybe from time to time. It was a fantastic week of football and incredible believe. We're gonna have Thursday games, Thanksgiving Day games. Giants, Cowboys, handful of others, but you and I will get to do this many more times between now and then. The great Martin Baccardax, awesome show, many topics. Thanks for hanging as always.
Thanks, JD.
You got it, man. That's going to do it for the market open here from the floor at the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. And we will see you tomorrow.